recording, the good part. So our network, as I mentioned, alumni is pretty great, and we have quite a few of you here today. If you'd like to use it, feel free to do that. I am probably going to keep everybody muted unless there's an opportunity to participate. So please know that your mic is muted. If you want to speak into the dialogue, you'll need to unmute. So let me introduce our guest speakers. Dr. Alan Featherstone developed and launched the MAB program and has been its director since inception. As a leading finance, Dr. Featherstone has assisted the industry in mergers and acquisitions, loan loss severity, the influences of taxes on farmland, and the federal tax systems. Dr. Vincent Amanor-Boadu is a professor in the Department of Agricultural Economics and teaches 2 courses in the MAB program. Dr. V's areas of research and outreach include business development and entrepreneurship, technology and innovation, and strategic management, with an emphasis on intergenerational relationships and governance. I'm going to turn it over to Dr. Featherstone so he can get started.
You'll need to unshare real quick, Deborah. Welcome. What we're going to spend a little bit of time, and Vincent and I will kind of get you thinking. I will speak a little bit in terms of thinking about risk management in a coronavirus world. I will talk about it from a macro standpoint in terms of some of the changes we've seen. And probably the big thing I think that's very important to realize is that the effects from a income and business aspect have really hit different industries differently. In terms of looking at that, in terms of how many of your firms had a pandemic plan as of February? In terms of February 1, 2020, how many of you were able to anticipate coronavirus? How many of you had a pandemic plan that was in your strategic management plan and you just moved into it and things were smooth sailing? I would be shocked if anybody raised their hand and said, yep, we were smooth sailing the whole time, was ready for it, and it unrolled just as we expected. I think one of the things to really think about is that managing risk basically includes, in some respects, this may be the biggest thing, is being agile enough to reinvent on the go. And I think a lot of us spent a lot of time reinventing on the go. In a university environment, basically that meant not bringing the students back from spring break, moving everything onto online, essentially emptying out the buildings to essentially keep everybody safe, and going through and talking to each individual and determining who needed to work at the university and who could work at home, dealing with all kinds of internet interruptions. And then that was just a part of it. Then the big thing is thinking about, how do we think about bringing people back? How do we think about moving forward in a safe environment? What do we do to increase the safety within the physical facilities? How do we think about bringing students back? All of those things are essentially determined on the go. And in some respects, that really has driven our world. In terms of the business environment, certainly that's changed. In terms of what I have here is essentially the cumulative unemployment claims since March 28. Essentially, through the week of September 12th, we're at 61 million people in the U.S. that filed for unemployment benefits. And so certainly you can see a sharp increase roughly through the end of May. And then that started to level off, but we still are adding between 750,000 and a million individuals looking at that, are filing those unemployment claims. With regards to the good news is a little bit in the orange line, where essentially we have the insured unemployment rate and our unemployment rate. And so one of the things you can end up seeing is that peaked at about 17.7% the first part of May, and we've essentially cut that in half. Certainly that's a very high level from historical perspectives, but to me it has really changed the labor market. It has really changed in terms of how we are working through the business environment. In terms of looking at GDP, and I have this all the way back to quarterly to 1947. One of the things I think that is pretty important to understand there is that we're pretty much in unprecedented numbers since the last quarter that ended in terms of July. In terms of on an annualized basis, we're to the situation where we're looking at a decrease in GDP of roughly 31%. And so we have almost lost a third of our GDP over this period in time. And so certainly that is an unprecedented basis with that respect. It'll be interesting to see kind of where we go in terms of the future, in terms of what we're looking at, in terms of seeing whether or not that bounces up in this quarter. Certainly there is some expectations. And this is where they talk about the V in terms of whether or not we have a huge downturn and then a huge increase. And so it will be certainly important to consider as we go forward. Interest rates, again, looking at a long-term trend, they continue to decrease. And this is the 10-year Treasury weekly average bond rate. You can see that essentially on a weekly basis, we've seen nothing but interest rates go down. They had been trending up kind of in 2018, 2019. We hit 2020, and essentially we're currently at a 10-year Treasury of about 0.67%. And so we're almost looking at a zero bond rate. In terms of, we also have the inflation protected security. One of the things to look at this is the real rate in the economy. And looking at that on a real basis, we're essentially having savers paying borrowers given that negative 1% rate. And that has dropped even below the previous low, which occurred in 2013. And so again, we see a lot of declines there associated with that. At the same time, the dollar has been strengthening. The last week or two, couple weeks there, we see that it has been declining. But since the pandemic began, we've actually seen a strengthening in the dollar, and that has backed off. We are quite a bit higher than we have, and so we continue to be in a world of a strengthening dollar. What has this done to commodity prices? What I've done here is look at these on a daily basis starting at February 3rd. One of the things you can end up seeing is you saw a big decline in the beef price. Again, I'm using future market prices here, where essentially the price dropped to about 70% of what they were kind of in that April to May period. Again, you saw a lot of situations there where the beef plants were processing plants were closed down. We have recovered a little bit, but again, we're still about 85% of where we were. Conversely, if we look at soybean prices, essentially on February 3rd, 2020, we've seen a flattening. They did end up declining a little bit kind of in that May to June period. And if we look at now, we're about 20% above where we were on a soybean price. Pork, you can see just the extreme variability on the commodity price. Again, there were issues in the April period with regards to being able to have the capacity to harvest those hogs. But up and down in terms of a couple times, for example, in the May period, we were at a 20% premium to what we were in February, and we're looking at that. And then you can look at the corn and wheat price. And in some respects, the wheat price is a little bit above where we were. The corn price is hitting. And so, again, a very difficult time for producers to manage, a very difficult time for agribusiness companies to think through in terms of what their supply chain is and just what the acquisition cost of raw material is going to be. Another way we can end up looking at this is just see where the S&P was. Again, when we started this period and before we really saw the downturn, basically, we lost roughly about 35% of the value from the middle of March until the end of March, first part of April. Since then, it's been a gradual, generally uptick in terms of the market. We ended up being about 110% of what we were at the first part of February, and we have dropped off, and so we're most recently just about where we are. But again, a very difficult thing for consumers, a very difficult thing for individuals that had their wealth and retirement tied up and trying to figure out, okay, what are we going to do from that perspective? It's also important to look at relatively where the food and egg sector is. And I picked some different stocks: Deere, ADM, Kroger, McDonald's, Elanco, Merck, Kellogg. One of the things in terms of looking at this, essentially all the food stocks have essentially got back to where they were at the beginning of February. I also have the S&P 500 in there. In terms of Deere, they're up about 40% since February. And then if you look at Kroger, they were up close to 40%. They backed off a little bit in the last month, but again, they're 20% above. Really the only stock that hasn't essentially hit the 100% or very close to the 100% is Elanco, but it's still about 85% of what it was, and it was down about 50%. And so again, if you look at that, in some respects, the argument could be is the food sector and the egg sector, a lot of those companies have fared pretty well through the period. That's very different than the picture with regards to some of the non-food and egg stocks. And this makes it extremely difficult to manage in these environments. And so I have Southwest Airlines, a domestic U.S. carrier, General Motors, Ford, American Airlines, Marriott, Hilton, Wells Fargo, PNC Bank. So I have a couple banks in there, and Amazon. Really the only one that's ended up a lot better than where we were is essentially Amazon. Amazon had a huge run up. Obviously, the way we get goods delivered has changed much differently through the pandemic. The food chain in terms of how we consume food has changed much differently. But you can see some of the companies like American Airlines, they're still about 50% of their stock value. In terms of Wells Fargo is in that 50 to 60% range. Then you have a number of companies that have kind of recovered a little bit, but the best of these is GM, which is about 93% of their stock value. But again, those non-discretionary items or those discretionary items have been hit much more than the non-discretionary items with regards to the food. And the last slide here is just looking at global indices in terms of if you think that the U.S. has been alone. It hasn't been. In terms of looking at this from where we are at the end of last week, the S&P 500 has recovered the most, right at 100%. You have some of the markets being 83, 84%, kind of looking at the Australian market. If you look at the France equity exchange. And so the big thing is that certainly COVID has been a global effect. It has strengthened the dollar. The U.S., their markets have fared relatively well, but you do see a lot of recovery across the globe. And so to finish up, the macroeconomic situation has changed drastically in terms of the way we view our world, and Vincent will get more into this with regards to looking at the firms, and we could kind of focus on different industries and think through that. But the world is drastically different than it was 7 months ago. I think it's very important to realize that various firms and industry have experienced differential outcomes. And while in some respects, those along the food and egg sector have done relatively well, there's still a lot of differential effects with regards to what's going on there. And with that, I think I will turn it over to Vincent. I'll see if there's any questions in the chat here real quick. Okay. Yeah, Nancy indicated that they had a plan, but certainly not robust enough, and so certainly that is there, and certainly that robustness is there. And so with this, I will turn it over to Vincent, and Vincent, you should be able to now control your slides.
Thank you very much, Alan. Okay. Can you see my screen now? Am I sharing?
Perfect.
Excellent. So I'm just going to take off from where Alan ended and look at the way that the coronavirus and other uncertainties are actually changing the way we think about enterprise risk management. For those of us who don't do it, and a lot of companies are not thinking about this at all. So I'll spend a little bit of time to challenge us in those, in thinking differently about it. And as Nancy responded to how many of us had a plan in place to deal with coronavirus, the response basically is, well, sometimes we plan, but we don't actually put these into effect in any way. So let me start by bringing us back to some basics and thinking about this from our company's perspective. So I'm going to move from the macro level to the micro level and recognize that our organizations are very complex. It doesn't matter how small an organization we are running, or if you are running a very large multinational, they are all very complex. They are also dynamic, and we can think about them in terms of systems. They are systems because all parts of the organization matter, from the janitor to the CEO's office. Everybody in the system matter, and relationships are complex because they are non-linear. Most of the time, we tend to think about things in terms of cause and effect without any interventions, but most cause and effect are separated by time and space, and that changes or forces us to think about relationships very differently. The third aspect I want to introduce for us to think about is that feedback loops exist in the system, and these loops have delays in them. The problem with delays is that they affect the way we can conceive of problems and their solutions. So Corona happened, and all of a sudden everybody is thinking about vaccines. And if we get a vaccine, then we are going to solve the problem. Well, in the race to a vaccine, we begin to discover that not only is it going to take us time together, but what are the potential effect of vaccines in terms of resistance, and is everybody who got a coronavirus and recovered, have they got antibody? So the science is now beginning to emerge, and those feedback loops and delays in natural systems are also natural. And this happens in all organizations because we are a system, we are complex, and we are dynamic. Now, how do we often think about our organizations? We tend to think about them in silos. We have the finance department, we have HR, we have management and execs are in one corner of the whole place. The joke is that, they're sitting on the 36th floor and they don't know what is going on the plant level. I mean, people track all these. But I want to just make a point that we put these silos together to look at accountability. Unfortunately, they become the way we manage, instead of us thinking about them as just a way of making sense of how we are managing. We use them instead to be management. If we think about our organizations then as systems, then like a clock or a wristwatch, we begin to see that you have all these gears in the system. And we might think about one of these gears as HR, we might think about one as production, finance. And the problem is that if you take any one of these gears away, the system begins to flop. It doesn't work the way you expect it to work. And so moving from this silo thinking into this systems thinking is something that in an environment that we are emerging into, we should begin to build skills to understand them and not only think about them, but also operate them. And those of us who've been thinking about enterprise risk management tend to try to do this. So let me pause a little and define enterprise risk management then as an integrated and continuous process for managing enterprise-wide risks to minimize unexpected performance variance and maximize intrinsic organizational value. So the coronavirus comes in, an unexpected event happens, and as Alan showed, if the S&P and all these commodity prices and everything is changing, we expect that unexpected performance variances are happening. The CEO magazine just published the poll from CEOs' expectation about performance for 2020. And about 25% of US CEOs think that they are going to be in the red. They are going to report a red for 2020 overall this year. So what enterprise risk management helps us then think about is that it drives us towards looking at specific, measurable, attainable, relevant, and time-constrained objectives and linking those to how we look at risk and manage risk, right? In this complex environment. It forces us also to look at governance, how we are making governance decisions, management decisions, and bringing it down to the operational level. And the way I always think about it is anybody who can think in the organization must be given a chance to play a role in managing enterprise risk. But the devil is always in the details. So let us then look at enterprise risk as risk measurement relative to objectives, right? We are moving them from this idea of efficiency, where we are trying to minimize, to effectiveness, where we are constrained by the objectives we want to achieve. So when we bring enterprise risk thinking into our conversations, then we are looking at metrics that allow us to look at corporate-wide risks, right? And also link those to business level risk and business level risk back to corporate level risk. So we're looking at earnings, we are looking at value, we are looking at cash flow, and everything in between. It is not about risk avoidance or even risk minimization. And the metaphor I use here is, let's use the metaphor of cost. If you want to pay the lowest cost for anything, then you probably will be riding not a very cute rickshaw like this. And if that is what we're all doing, nobody is going to be riding a Mercedes, okay? It is about optimizing that risk-return trade-off. And it's extremely important for us then, when we are having these conversations about risks, that we don't overlook the potential returns that come from them. Because as we saw in the graphs that Alan showed us, especially on the corporate performance, Amazon's performance has been great, not because it refused to do certain things or avoided certain things, but actually positioned itself in such a way that when this event happened, it had a solution to it. It had built the relationships across the system to allow us to take full advantage of it. So when we think about risk, often we are looking at, the bell curve and trying to optimize the bell curve, especially the tails of the bell curve, so that we are making them as thin as possible, reducing the potential for these tail end problems that we see, right? But we want to actually think about the problem as a lot of moving parts. It's no longer just a nice probability distribution that we are managing. The interesting thing is, because coronavirus happened, and seriously, it's not the first coronavirus that we've seen, but this is the one that had a global attention to it. And because it has happened, it's going to influence everything else that we do from now. It's like on September 10th, 2001, nobody had flown a plane deliberately into a building. And therefore, if you wanted to transfer the risk of planes running into a building, you probably could have got it for the cheapest premiums possible. On September 11th, you couldn't write any insurance for that risk. And since it has been built into the whole process of risk appreciation. So the point is, we are now looking at not just a very nice flow of data that we can look at variances and measure them, but you have a situation where everything is changing. We are moving from a situation of risk now into a situation of uncertainty. And when you have these increasing uncertainties, you have to change strategy. You have to prepare yourself for surprise instead of against surprise, as James Carr says. We have to rethink the variables that go into our risk assessments and how we measure them. When we are looking at something like standard deviation, you are looking at the difference between a variable and its mean over time. When you are doing that and the variable is changing, but the mean is also changing and the number of players are changing, it becomes very difficult for standard deviation to make a lot of sense if they are using that to measure risk. So we have to rethink everything. We have to build accurate models, not precise models, but accurate models that represent our reality, and therefore develop insightful analytical tools that allow us to focus on the things that matter to our performance indicators. And then we have to embrace what I'm calling effectiveness and be suspicious of efficiency, because efficiency drives us from doing the things that allow us to focus on the results we are seeking, because it focuses a lot on the bottom end, the resources that we are using, right? So I'm going to stop at this point so that we can spend the time talking with you instead of to you. And I will give the screen share back to Deborah. So, Deborah, do you have it? Or yeah.
Okay, well, before we open up to questions, please allow me to talk through some things you may be interested in. If you're not an alumni, but you're interested in the program, I'd love to visit with you to hear more about your career goals and talk through how we might be a great fit for you. Additionally, I cannot. If you'd like to learn more about managing through crisis, Dr. V and Dr. Featherstone are offering a workshop on October 8th. So this workshop will be both virtual and face-to-face, and will give you the ability to identify potential sources of transformational risks in your organization, some of which we talked about today. And then as you're leaving, participants will be able to hone risk assessment skills within the context of their organization's supply chains. So I also want to point out that webinar attendees today do receive a 50% discount on the registration with the code webinar. So feel free to contact us or visit the K-State Olathe site for more information about that opportunity. If you are an alumni, we'd love to hear from you about topics for upcoming webinars over the next few months. And we'd also like to share with you some new ways you can get involved with the program. I hope you feel free to reach out at any time by email or phone. But also stay tuned for some more alumni Zoom reunions. We'll be doing a few more of those over the next few months. And finally, we'd love to connect with you through our social media channels. Our students and alumni are very active on these channels, so it's a great way to start meeting in the MAB and get re-networked with folks maybe you haven't talked with in a while. Okay, let's take some time for questions. So again, you can either enter your questions into the Zoom chat feature, or you can tweet to the @KSUMAB with the hashtag MAB webinar, and I can relate those forward. So let's feel free. Anybody have questions or comments?
There's a question for Nancy in terms of how do you think the ethanol industry will adjust? That's a big driver, certainly, and we didn't look at the fuel industry, and certainly I think that's an important aspect there. In some respects, I think it's going to be very much with regards to the relaxation of the mandate, or whether or not that'll tighten up with regards to the fuel costs. Right now, I think if you look at the supply and demand of fuel, we have more supply than we have demand. Certainly gas prices are quite a bit lower than they were a year ago at this point. And so I think there's a couple issues to that question. One is the domestic demand in terms of looking at that. I think the other thing will be internationally, what will be the opportunity to export ethanol. But certainly that's an industry that has had a lot of stress over time. Do you have thoughts, Vincent?
Yeah, I think you are dead on. I think that the policy end is going to be really critical for this industry. If we move into where the standards are eliminated, it's going to be a lot tougher for them.
Perfect. I'll use that, and we'll go that route. And hopefully, that won't be an issue with that. So,
a lot of times,
Rusty, do you want to mute your?
And they have taken and accepted just that tax exempt number and the tax exempt, the federal ID, and gone with that. So
okay.
Hopefully that'll work.
Okay. Done that. Michael, have you compared and contrasted financial performance for essential industries through the crisis versus non-essential? No, I haven't. I haven't looked at those essential industries. What I have done is looked at the beginning of the crisis, I looked at some of the agri-food industries, which were declared essential. But some of the reports that are coming out, for example, the CEOs that I've visited with and looking at some of the reports from organizational magazines like CEO Magazine, a lot of CEOs, for example, are basically putting a halt on travel, non-essential travel, especially with what a lot of organizations have seen during the crisis with respect to performance and productivity. So if they could do everything that they used to do traveling now, and they are no longer doing the traveling, I have a hard time seeing how travel is going to come back to the levels that they were before. The effect of that on the airline industry, the car rental industry, and the hotel and hospitality industry going forward can be significantly high. For example, business class tickets have been cross-subsidizing the economy class tickets for a long time. If we now cut back on business travel, then what we are going to see is that economy tickets are going to go up, which is going to then affect the normal travel business. So while I haven't done that, we can have some idea about the potential spilloffs into things that individuals are defining as essential or non-essential. Alan?
And again, I think you're going to see some differences between how the essential, what people view as essential and what they view as non-essential. And I think you saw that a little bit in some of the industries. Certainly, American Airlines has performed so much worse than other companies, and whether or not they're able to bring that back, I think will be very, very interesting. But certainly we can dive into that a little bit deeper, and we will at the upcoming seminar, is to begin to look at that. Dwayne has a question in terms of concerns about printing money and looking at the risks associated with that. In terms of there is big concerns, but so far, if you look at any of the inflation expectations, the inflation expectations are very low. And I've actually traced that over time by kind of tracking, for example, the T-bill and the TIPS rate. And the spread between those has remained pretty steady over time. And so while there is concern, and that will be something I think the Fed will have to keep their eye on, I think it's going to be very important to, as much as possible, look at some of those possibilities to hedge inflation. And one of the tools that we have now that we didn't previously is we do have the TIPS rate. And so there are ways to, again, to push that risk off on someone else. Again, with that risk return trade-off, there is going to be a price associated with that in terms of the risk, but there are more tools to deal with that than there have been previously.
Dave is referring to the article in Wall Street Journal today about meat prices still going down and processing capacity exports. The debate continues about additional financial relief for farmers. What do you anticipate for recovery for producers?
My view on this would have been much differently about a month and a half ago than it is today, in terms of essentially in the last month and a half, and you actually see that on the graphs. The crop enterprises have really moved up quite a bit. And in terms of soybeans, have probably recovered about $1.50 a bushel over the last month or so. You're looking at cash prices depending on where you are, $9.50, $10 a bushel. Corn is kind of in the upper threes, mid to upper threes, and so the crop prices have recovered quite a bit. Part of it is China is coming in and purchasing. Whether or not they're meeting their agreements, I think is still open. But the main sector that's still struggling is the beef sector, in terms of they have not recovered from where we were in February, and so who knows with regards to additional financial relief. The original financial relief was covered through the middle of April into the middle of May, depending on the commodity. The second round is going to go a little bit further, but the profitability, at least on the crop side, is dramatically different than it was about a month and a half ago, which is good from a producer perspective, maybe less good from an individual that uses those commodities. Steve has a question. Would you elaborate on the slide that mentions the embrace effectiveness and suspect efficiency? That's
Yes.
a Vincent question.
Yeah. I know that a lot of when we're under stress, the whole idea is to basically overhaul your processes, cut cost, and all that. The risk there is to cut beyond where you will have the slack to be able to deal with the uncertainties. The companies that don't have any slack at all because they are right to the bone, because they are being extremely efficient, are unable to respond when the unexpected happens. And that is why I say we have to be focused on effectiveness, which is objective constrained optimization instead of optimization for pure cost basis, right? So if our objective is to build the resilience of the company to be able to deal with these uncertainties, then building slack into the operations makes sense. We then basically recognizing a trade-off that we are going to be not as efficient as we can be, but then we are taking on that inefficiency as the premium we are paying to be more capable of addressing the uncertainties that are bound to hit us. Does that make sense, Steve? Tim, how do you think the dairy industry will adjust? Will there be more federal intervention in dairy? Or with the decline of the restaurant industry? I would add to what Alan was saying earlier about the beef industry's challenges, because I think there's one MAB student that I'm working with right now looking at the multiple cuts or multiple products from cattle. Compared to chicken, for example. And with the collapse of the restaurant industry, the beef industry took a lot more hard hit than probably any other industry, with the exception of probably the dairy industry. I think that there are a number of factors that are also feeding into the system beyond just the coronavirus. I think that even though that market is small at the moment, this whole nut milk competitors are growing very rapidly. And we need to think from the dairy industry perspective, think about how to address some of those challenges from that end. The interesting thing that I think is happening is that this is where looking at corporate strategy compared to industry level strategy becomes a little more difficult, because the nut industry, or the nut milk and the non-animal protein market that is emerging are all pulling from the agricultural sector, the raw materials. And so how do you at a higher level where you are looking at the whole sector manage those relationships? And so the industry focus on how it manages its own risks, the company focus on how it manages its own risk becomes extremely important. But I think that we are going to see continuous pressure on how these industries link to communities, link to economic development, link to employment and all that. And policy is going to come in to try and alleviate those. My position for those of you who have taken my class has always been that whatever policy gives, policy can take. So building your resilience at the corporate level, at the organizational level, so that you can deal with the uncertainties that are emerging is always important. And then you can take whatever policy gives you as icing on the cake, because the cake will still be there if there was no icing on it.
One of the questions that Daniel has with regards to local farmers, producers, and whether or not they will benefit from the pandemic as they have access to the market. On the livestock side, it's quite interesting. A lot of those local butchers are backed up in terms of my brother-in-law's farm in Nebraska, and they grow some hogs. If you want to have a hog locally butchered, you are booking right now for April of 2021. And so essentially, you can't get a hog processed, at least in their area, for roughly 6 months. Beef, same type of thing in terms of there's a booking. Some individuals are already booking for fall of 2021 for the beef side, simply because there is a concern in having that space. And so it'll be interesting, certainly, to play out. In terms of Jacob has a comment there. From my lending perspective in North Dakota, most of my producers have witnessed some relief on the commodity basis levels due to Chinese purchases, recent US dollar weaknesses, and most yields being at APH levels. In terms of, do you see the basis remaining firm or becoming more sporadic widening as we proceed through the end of the election year? In terms of, I think the agreement, in some respects, will continue to operate. My guess is that I think the purchases will continue trying to meet that. Certainly, there would be a high cost, for example, if they backed off of that and the Trump administration was reelected. And so I think that Chinese will continue to purchase throughout there. Again, I think it's going to be a good time for basis levels. I think the other thing that's starting to occur, and I don't know in terms of, we have at least one or two Brazilians on there, in terms of La Nina, in terms of essentially we're looking at, instead of an El Nino, we're looking at a La Nina. And certainly that has negative effects in different parts of the world from commodity production. And so I think another thing that could be rising is just weather patterns in terms of, we haven't focused on those too much with all the issues out there, but you do see certainly there are some patterns affecting La Nina. And I don't know, Katia, in terms of if you have thoughts with regards to rainfall prospects and that with production in Brazil. Go ahead.
Yeah. Yes. For now, there is a pretty small delay on the soybean planting, but it's something that is not worrying till today. We still have some rains in the 11-15 period. So it might delay a little bit the curve, but it's not a concern yet. But yes, we are watching the La Nina.
And generally, is La Nina a good thing or not a good thing?
No, it's usually drier. It's drier center, so not good. But anyway, it depends. It was 79%, so it depends the intensity of it. Yeah, it's a very small delay. Of course, planting can catch up in October, but then what's going to happen, we're going to harvest less volume in January. That's the thing so far. So we are not decreasing yield nor area for now.
The debt and deficit, in terms of, Dave Rock had a question on the debt and deficit there, in terms of the increasing taxes. Certainly, I think that is going to be an uncertainty. I think Dave, some of that's going to be resolved in the election. In terms of one of the things that the Trump administration had indicated that they do intend to focus if they have a second term is essentially managing that deficit and debt. I don't know with regards to Biden's plans whether or not that will be quite as important of an issue, but certainly with the amount of debt that we borrowed during this pandemic, that's going to be something that somebody will need to address at some point as we move forward. But again, just another piece of uncertainty that will need to be managed, and kind of think through that whole process. Vincent, do you have thoughts?
I was just going to actually poll people on how many of us are thinking at a corporate level of major capital investments in the coming year or so. Because at the moment, I think corporate debt is right, probably a lot less stressed at the moment compared to what we are seeing at the national levels. But what are we looking at? Anybody want to talk about how they are looking at going forward, looking at your ratios, for example? Okay. Any other questions or thoughts?
We are all clear on Twitter. Thank you for getting to Claire's question. Oh, Michael just threw something out.
Yeah. So CapEx hasn't changed. We're still in good shape on the balance sheet. Interest rates are still low. So, I mean, my thinking with respect, I think a lot of companies are not very different from what Michael just pointed out. The federal level debt issues, I have not really ever been concerned about, mainly because maybe I'm not a macroeconomist and I don't think a lot at that level. But I think a lot of the borrowing that we've done is also from as I think Dave said, printing money here at home, borrowing from ourselves. So that the risk of that eventually to people making claims on it and potentially affecting the dollar, which is often what happens when small countries borrow, they usually borrow in the US dollar. So as the US dollar strengthens, then their cost of borrowing goes up significantly, which then affects their local currencies. So, I mean, given the situations we have here in the US, I'm not worrying so much about that, especially as Alan pointed out, when you look at the effect of all this deficit on the inflation indicators, the markets don't seem to be very worried about it at the moment. So I think I'm not worrying about it. I think we should, from the company perspective, organizations should continue to focus on that because you can't print money. You are going to have an effect on the balance sheet if you go the way we did maybe a decade or so ago on the corporate side.
But certainly thinking about capital investment, I think you really need to focus on the profitability side and get in the position yourself for where your industry is going to come out. And one of the things I know the food industry is facing is we went from essentially 50-50 consumption at home to about 100% consumption at home. It'll be really interesting to find out where we're going to end up, whether or not it's 75-25, whether or not we continue to consume more at home, whether or not it goes back to where we are. Is really an unknown, and so we're going to have to look at people's behavior, and in some respects that behavior is very uncertain in terms of individuals are making that decision in their own mind with regards to the social aspect of food versus the safety, and part of it I think goes back to Claire's question with regards to if there is a second wave, what that will do. At least some of the individuals that I talk to, they're tired and they want to get back to normal, but there's a certain amount of trepidation in terms of doing it, and so. I think, at least in the food industry, I think agility is going to be a key phrase as we go forward. In terms of, I think you're almost going to have to plan for 2 tracks and then at some point basically make that decision in terms of where we're going to go, because just a lot of uncertainty, and it's hard to know in terms of where people's behavior is going to come out. Any last questions? Again, one of the things that we hope to do in the seminar that we're flipping through the slides there is we hope to learn from each other. And so one of the things that we're going to try to do is kind of look at lessons learned and things that worked well, things that didn't work well. Certainly, I think agility is going to be key. And so kind of understanding what others tried and worked and what others tried and didn't work, I think will be a key component in terms of lessons learned and opportunities for the future as we think about will there be a second wave? Are we kind of leveling off? But there's a wealth of wisdom out there that people have gained working through the pandemic in terms of what's worked, what hasn't worked, that I think it's very important as we are heading in the Northern Hemisphere into the fall and in the winter. This is where we're going. So with that, we'll turn it over to Deborah, I believe.
Thank you, Dr. Featherstone. I just want to thank all of you again for being with us today. We will have a recording of the presentation. We will have an MP4 available. We'll also have it available on our YouTube page. So we'll get that information out to you, and please watch for a follow-up survey that will give you the opportunity to suggest topics for the future. We'd like to make this a monthly feature of the MAB program, doing some skill set development and just giving opportunities for especially our alumni to come together and visit and maybe interact with some folks who are looking at the program, but mostly just refresh any skill sets that you think would be helpful and kind of move forward together. Thank you so much, Dr. Featherstone, for being with us today, and go Cats!
Oh, what?